there's a lot of interesting things that's happening in the market. Anything from the market, pricing in Fed rate cuts in June of 2023 in summer pretty much, from other things I'm seeing in the gold market, from oil crashing down, no matter about OPEC or the fundamentals or anything, from the relationship between the Nasdaq and the S&P. I'm going to give you guys a couple of charts, and I'm also going to talk about that if we're ever going to have fear and capitulation, which we haven't had yet. You could look at Nvidia stock, how it's rallying. There's no fear and capitulation in sight. But if we will ever have something bad happening, it will most likely come in the late third to the fourth quarter of 2023. I think this is a time where we should, be, a little bit more cautious going into this time. And I'm going to share exactly why in this video. But one of the most surprising things for me was actually the market pricing in those cuts in 2023. And this is the main reason for the Nvidia rally, for the Bitcoin rally, is easing of financial conditions. This is when these growth stocks and cryptocurrencies actually rally. But this is what the market is pricing in: 4.7% by June, 4.5% in July, 4% in October, and then 3.5% in January of 2024. And we have to ask ourselves, what is going to happen for the Fed to start cutting in June? Is it just inflation coming down because of the lag in the housing market and because of oil? Or is it because of something else? And I'm sure most of you guys know that whenever the Fed actually starts cutting rates, this is normally when the market has its biggest correction. Not before they cut, but we normally bottom after they do cut rates, which really makes this whole environment very, very difficult of trying to assess, has the market bottom, what could happen in the future, where we could go next, if we're going to have, another bank fail or not. And this is where I rely on some pretty basic, technicals, which I'm going to share with you guys, in the video. And you can clearly see this trend line that's been happening pretty much from the March 2020. A lot of stocks and the S&P 500 have been holding this trend line. It touched it around, pretty close to the October lows in 2023, and we are still above this trend line. And this is a guide that I've been using of when I believe, we could, make new lows, or if I should be bullish or more bearish. And as long as we're above this trend line, which now we have to break below 3750 to break it, but as long as we're above, we're most likely still in a bullish trend. Although it's been rejecting another, pretty short-term trend line over here, but we're still in a bullish trend on the S&P 500, which is why I wasn't, shorting like crazy and then, doing all those things. I haven't, had such huge short positions like I used to have, over here whenever we were correcting in 2022, because I'm watching the trend line. If we do go below the trend line, now you could maybe look at retesting, the October lows of 34.94. If we do break the October lows, then there's no support on the market before 3200, which is the double bottom from September or October of 2020. So the market still is leaning bullish, in my opinion, in the short term, and it's largely fueled by what I showed you around, the Fed cutting rates in 2023, which could be possible. But if the Fed ends up being right and the market ends up being wrong, I believe we're going to correct in a major way, where the market has to reprice 5% rates for all of 2023. But now it's rallying because it's pricing in cuts. But if this perception changes for whatever reason, then the market could break down in a major way. We could look at rates. I believe rates have most likely peaked. As you could see on the trend line, it broke down. This is the 10-year yield of the government bond, and it's now around 3.38%, and it's most likely, going lower. I don't know if we're going to get back above the trend line, but my bet would be that, maybe bonds have bottomed, TLT might have bottomed, and maybe it's going up from here in 2023 as we have more disinflation in the second half because of things like, crude oil is going down. It's not stopping going down. OPEC is not saving crude oil. Biden buying oil is not saving crude oil. Nothing is pretty much saving it. And we had the same thing in 2008. And it was an indicator that the recession is getting deeper, that we're going deeper and deeper into the recession. And this is what oil is indicating, which was my whole point whenever I was arguing with a lot of people on oil last year. I was telling them that oil doesn't trade on fundamentals in the short term. It trades on expectations of those fundamentals. And this is why oil dropped pretty close to around 79, 77% in 2008. It didn't drop 77% because we had 77% more supply or we had 77% less demand. No, there was a lot of fear. And this is what caused oil to go down. And now we're having the same thing. And this will likely help a lot on easing inflation. You also have the lagging from the housing markets, the way they calculate it. It's starting, it's going to start to reverse more soon. And all of those things are putting downward pressure on inflation, which is starting to show up in the next few months, in my personal opinion. Now, this is why I believe if we're going to have something bad happen, it will most likely happen in the second half of 2023. One of the things that we had the debt ceiling issue. And in terms of dealing with what we had in terms of the debt and all the obligations, the TGA, the Treasury General Account, had to put in liquidity in the system basically by extraordinary measures to try to deal with the expenses that the US government actually has. But this ability to borrow using extraordinary measures, it will be exhausted between July and September. So from now then, the Treasury account is going to be most likely empty, and then we're going to have some type of a debt ceiling, I believe, solution. But once we have the solution and the debt ceiling is raised, what has ended up happening, all the liquidity that the TGA actually put in the markets, they're going to have to withdraw it back. And in the same time, you have the Fed is going to withdraw more liquidity. So you have double QT, which would set up for something bad potentially happening. But something else we have in the second half of 2023 is we will most likely have to repay student loans again. And as you know, President Biden has paused student loan repayment, but this is getting pretty close to the end, and it's now in the hands of the Supreme Court, in my personal opinion. And this is what this article says. It says millions of borrowers will face repayment in 2023. Student loan payments will resume 60 days following the Supreme Court's decision, or 60 days following June 30. So the decision is in June 30, 60 days after that, they're going to have to start repaying student loans. And as you know, we had credit card debt skyrocket. We're already having people default on subprime auto loans, and you add above that student loan repayment, that would lead to a pretty bad scenario, in my opinion, not just from a systemic issue, but also from an earnings issue, which the S&P EPS is still at 222. And you could potentially have another EPS revision in the third quarter once we have, all those things coming together, is the TGA, the Fed withdrawing liquidity, student loans being resumed, and all those type of, things. And it could go pretty close to 195 to 200 of EPS. And this is the argument that I made. I put in, 200 EPS, and you time it by 16 multiple. This is 3,200 on the S&P, which matches perfectly with the double bottom of the support that I showed you of around 30 to 34. And that would be a pretty perfect bottom. It would flush out all the excess in the market, all the NVIDIA shareholders that, saying is going to go to the moon, and valuation doesn't matter because AI is the future. All those things are going to have to be wiped out. If we do want a sustainable rally in the stock market, if we want a healthy rally that's going to last, 3, 4, 5, 10 years, we need to flush out the excess in the stock market. And we did some of it, some of it in the Cassie Wood arc. A lot of those stocks got flushed out, maybe a little bit in the cryptocurrency was what happened over there, but we still have a long way to go, in my opinion. And an ideal bottom would be around 3,200, where we flush out all the speculation and investors experience fear and capitulation. They give up on the stock markets. They want to go buy real estate. They want to, put it in a savings account or buy the S&Ps. They don't want to pick individual stocks. This is a classic, healthy bottom that I believe we should most likely have. But if we should have it, it doesn't mean we will have it. Maybe we just keep going up. But this is why I'm following this chart that I showed you guys here. And if we do break, below this trend line that's been holding up amazingly well from March 2020 and from October, then we could have a chance, in my opinion, of actually retesting 34.94 and maybe go all the way down to 3,200. But I will keep you guys updated on everything I find. I try to do those things around Sunday, once a week. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.